In 2007, one of the richest men in the world paid nothing in federal income tax. Not a reduced amount. Zero. He did it again in 2011. This is how the rich avoid taxes. And it is not fraud. It is not an offshore account. And it is not a loophole somebody snuck into the code at midnight. It is a three-step strategy so well established that law professors gave it a name decades ago. It is called buy, borrow, die. I am going to show you all three steps, the actual numbers at each one, and exactly why it is legal. And then the part almost nobody covers. Which pieces of this you can legally run yourself on a normal income. Because two of the three steps are already available to you. Start with the thing that makes all of this work. The U.S. tax code does not tax wealth. It taxes income. Those are different words, and the difference is worth billions. You earn a salary. Before that money reaches your account, income tax comes out, and payroll tax comes out on top of it. A W-2 paycheck is the most heavily taxed, least flexible form of money in the entire code. You are taxed on it immediately, automatically, and there is very little you can do about the timing. Now take someone whose wealth is $100 million of company stock. That stock went up this year. How much tax do they owe on that gain? Nothing. Zero. Because under U.S. law, a gain is not income until you sell. Until then, it is an unrealized gain, and unrealized gains are not taxed. The number on the screen went up. The person got richer, and no taxable event occurred. This is why the salaries look so strange when you actually look them up. Some of the wealthiest founders in America take a salary of a few tens of thousands of dollars. Some take literally nothing. Not modesty, engineering. A salary is the one kind of money the code taxes hardest, so they simply do not take one. So here is the puzzle. You are taxed when you earn. They are taxed when they sell. And they never sell. And I know exactly what you are thinking, because it is the right question. They have to sell something. Nobody buys a house with stock they never sold. They need cash, for groceries, for a jet, for a divorce. So where does the money to live on actually come from, if it never comes from selling? That answer is step 2, and it is the step that makes the whole thing work. Step 1 is buy. Not buy things, buy assets. Specifically, assets that go up in value without generating anything the code recognizes as income. Company stock, real estate, and whole businesses. The defining feature is that they can appreciate for 40 years and produce zero taxable events along the way, as long as you do not sell them. Take a founder with stock she was issued early, when the company was worth almost nothing. Her cost basis, what she paid, is close to zero. That stock is now worth $100 million. Her lifetime tax bill on that $100 million so far, nothing. Compare that to the nurse in the thumbnail. She earns $64,000. Her tax is calculated, withheld, and gone before she ever sees the money. She has no timing control at all. The founder has total timing control because she chose an asset that only triggers tax when she decides to trigger it. This is also why the asset choice is so specific. Dividends are taxable whether you want the cash or not, so the strategy favors assets that pay no dividend and simply appreciate. It is not a coincidence that some of the most famous holding companies in America have never paid a dividend in their history. So step 1 is not clever. It is just a different container. Same dollars, different tax treatment, because the code taxes what the money is called rather than what it is worth. Okay, so she has $100 million in stock and no income. On paper, she looks almost unemployed. Now she wants $20 million in cash. And here is where a banker walks in with a product you have probably never been offered that turns her stock into spendable money without her selling a single share. This is the step that does the real work. She has 2 ways to get cash out of that stock. Watch what each one costs. Door number 1, sell. She sells $10 million of stock with a near zero basis. That is a $10 million long-term capital gain. At the top long-term rate, plus the net investment income tax on top, she owes roughly $2.33 million. Gone permanently that year. And she now owns $10 million less of an asset that was compounding. Door number 2, borrow. She walks into her brokerage, pledges her portfolio as collateral, and takes out a securities-based line of credit against it. Here is the entire trick, and it is one sentence. Borrowed money is not income. It has never been income under the tax code, for anyone, ever, and for an obvious reason. A loan is not a gain. You have to pay it back. Your mortgage is not taxed as income, neither is hers. So she takes $10 million in cash, spends it on whatever she wants, and the tax owed on that $10 million is zero. Now the numbers. That loan carries interest. Call it low single digits for a client pledging a 9-figure portfolio. On $10 million, that is a few $100,000 a year. So compare honestly. Selling costs her roughly $2.33 million immediately. Borrowing costs her a few $100,000 a year, and the full $100 million stays invested and keeps compounding. That is the whole engine. If the portfolio grows faster than the loan interest, the debt is effectively free. The asset outruns the loan. She lives on borrowed money, tax-free, indefinitely, and her net worth goes up the entire time she is doing it. This is not exotic. It is a listed product. The reason it was never offered to you is that it requires a large portfolio to pledge. The collateral is the qualification, but a loan has to be repaid. Eventually, somebody settles up. The stock finally gets sold, and the tax bill finally comes due. That is what you are thinking, and it is completely reasonable. It is also wrong. Step 3 is the reason the tax bill never comes due, and when you hear it, you are going to think, I am making it up. I am not. It is one line in the code. The founder dies. Her heirs inherit $100 million in stock and a $10 million loan against it. Now the tax bill arrives, right? No. Here is what actually happens, and it is called the step-up in basis. When an asset passes to an heir at death, the heir's cost basis resets to the market value on that date. Her basis was zero. Their basis is now $100 million. So the heirs sell the shares the next morning for $100 million. Their basis is $100 million. Their capital gain is zero. Their capital gains tax is zero. Read that again. The entire $100 million gain, 40 years of appreciation, was never taxed. Not deferred, not postponed, erased. The heirs use part of the proceeds to pay off the loan, keep the rest, and the lifetime gain simply left the tax system without ever being touched. That is the loop closing. Buy an asset that is never taxed while it grows, borrow against it so you never have to sell, die. And the growth is wiped clean on the way to your children. Buy, borrow, die. Now the honest part, because you will see it in the comments. There is still an estate tax above a very large exemption. It is real. It is also the most avoided tax in America. Trusts, foundations, and charitable structures exist largely to work around it, and there is an entire profession dedicated to it. And that is how you end up with the number that started this whole conversation. Reporting from ProPublica, based on IRS data it obtained, found that over a 5-year stretch, the 25 richest Americans paid a true tax rate of a few percent when you measure the tax against how much their wealth actually grew. Not because they broke the law, because they never triggered it. Now, you are not pledging founder stock against an 8-figure line of credit, and I am not going to insult you by pretending otherwise. So here is why I actually made this video. 2 of those 3 steps are legally available to you right now, at your income, and one of them is a decision inside your own family that is worth 6 figures and almost nobody knows it exists. That is the rest of this video. Quick line first, and I mean it. This is education, not tax advice. Anything here that touches an estate or a donation, confirm with a CPA before you act. Step 1. Buy. You already have. When you hold a broad index fund and do not trade it, you are running exactly the founder's strategy at household scale. Every year you do not sell is a year the gain compounds untaxed. This is the boring, unglamorous reason buy and hold beats active trading even before fees. The trader realizes gains and pays tax every year, and that tax comes straight out of the compounding. Doing nothing is a tax strategy. One correction that follows directly from Section 1. Chasing high dividend stocks in a taxable account for the income is working against you. Dividends are taxed, whether you wanted the cash or not. That is income you did not choose to take. There is also a version of the strategy that beats the billionaires, and it is sitting in your benefits portal. A Roth. Money goes in taxed once, and then it grows and comes out completely tax-free forever. The founder deferred her tax for a lifetime. In a Roth, you finished paying it. Step 3. Die is the one I actually want you to hear, because it is a real decision your family may be facing right now. The step-up in basis is not a billionaire provision. It applies to your parents' house and your parents' brokerage account. So if an aging parent owns an asset that has gone way up, a house bought decades ago, stock held forever, selling it while they are alive can realize a massive taxable gain. Passing it to you at death can erase that same gain entirely. Same asset, same family, wildly different tax bill, decided purely by timing. And note this carefully, because people get it backwards. Gifting the asset to you while they are alive hands you their old low basis. Inheriting it resets the basis. Those are opposite outcomes. The critical exception, and please do not miss this one, retirement accounts do not work this way. An inherited traditional IRA or 401k gets no step up. That money is still fully taxable to your heirs when they withdraw it. Taxable brokerage accounts and property, yes. Retirement accounts, no. One more from the same playbook. If you give to charity, give appreciated shares directly instead of cash. You deduct the full value, and neither you nor the charity ever pays the gain on it. And step 2, borrow. Yes, retail versions exist, margin loans, home equity lines. I am telling you to be extremely careful. The founder borrows $10 million against $100 million. Her collateral is 10 times her loan, so a crash is survivable. If you borrow heavily against a portfolio and it falls, the broker can force a sale at the exact bottom, and you have converted a paper loss into a permanent one. The billionaire's version works because of the size of the cushion. Yours does not have that cushion. So, buy assets rather than income. Borrow against them instead of selling. Die, and the step-up erases the gain. 3 steps. No fraud. No offshore anything. Every step of it legal. Just a code that taxes selling and never taxes holding. You can run the first step today. You can beat it outright with a Roth. And the third step is a conversation worth having with your family this year. Subscribe. Every Tuesday I break down one more piece of how to build real financial security on a normal income. Next Tuesday, Roth versus traditional 401k. Which one actually wins, and why the answer is a bet on a tax rate 30 years from now. Drop a comment. Did you know about the step-up in basis before this video? I genuinely want to know how many people have never heard of it. See you next Tuesday.